In this Iceberg Explained, we're going to be talking about commercial real estate or real estate investing in general. I think this is a great format to explain a lot of the popular misconceptions and what people think about real estate investing from an attorney and seasoned commercial investor. So let's start at the top. We're looking at invest in land. And this comes from a popular saying, land, they aren't making more of it. And it's definitely true, but there's a lot of ways to lose money because if you're buying land that is cash flow negative, you can run out of money before you're able to realize a profit on the land. So while scarce land is definitely true, it is a long-term investment that you need to be sure of your exit. Tax benefits. I think everybody knows buy real estate, you get taxed. But what exactly does that mean? And do you have the right type of income to offset to actually be beneficial? So let's go to the next level. Highest returns. This is definitely true. I think that you can actively manage a piece of real estate and generate some of the highest returns with an active involvement. So that's kind of the caveat is, yes, you could beat the stock market, maybe not beating individual stocks, but you're going to have to invest a lot of time. It's going to require an investment of your time and energy and focus. So you can get higher returns, but you also have to put in the work. Mailbox money. Everybody wants real estate because it's perceived mailbox money in that you sit at home, do nothing, and collect your rent checks. While it's definitely true that you can collect your rent via the mail, you still have to do some work or set up the right type of investment so that you can literally do nothing or pay other people to manage the investment for you. Same for passive income. I really don't like that phrase. Passive income is kind of a myth because even if you're at the highest level investing as a limited partner into large syndicated deals, you have to do a lot of due diligence on your sponsors. You need to review their investment thesis. You need to look at different deals, and you need a high level of trust with your investor partners to trust that they're going to generate good returns with your money. And so the passive part, sure, that can come later after you've placed your money, but the active part either comes first or comes in the middle or comes at the end. And there's really no way of getting around that. Let's go to the next level. Control over decision making. This is really something that I think people don't realize is you can really make a lot of decisions. Even for a fully occupied, cash flowing, stable property, you can raise rents. You can charge more for other things. You can still invest into the building, and you can structure your debt or other tax or other expenses, and you can control your expenses to increase your NOI. That's your net operating income. Buying assets below market value. I think that this is really important. A lot of analogies with the stock market, but if you can buy a single asset at a current price of what's below the future market value, or even today's market value, if you're able to act quickly or take more risk, this is a really easy way to acquire assets and have positive equity in a very short time. Next level. Now we're getting deeper. Details are in the lease are critical. Everybody just glosses over, oh, they have a triple net lease. Oh, they have a gross lease. Oh, they have a net lease. There are so many permutations. There are no standard leases in the commercial real estate world. You've got to read all of the details. Beyond just things like the base rent, OpEx, reimbursement timelines, building maintenance obligations, there are a lot of details in the lease that can make or break the value of that cash flow. And the same note, your lender is a critical partner. And while I do think that money is all fungible, the lender can really make or break the deal depending on how flexible they are in working with you as a borrower. And so building those relationships and really scrutinizing individual terms of the deal really are going to make or break the deal. Let's go to the next level. The reality is there's no shortage of money. Good deals always attract capital. And I think a lot of people starting out say, oh, how am I going to get this down payment? How do I get $300,000? How do I get $600,000? How do I raise $2 million? Doesn't matter. Get a good deal first. Get it under contract, get it under control, and investors need yield. It's especially true in this market where T-bills are at 1 point something, pitiful 10-year return. People are desperate for yield, so you need to shop good deals around and the money will come. Assembling portfolios equals arbitrage. This is the closest thing you can do in commercial real estate, and essentially this premise is that you assemble a lot of, say, $1 million retail parcels in a specific geographic area, say Houston, Texas, and you assemble a like kind in terms of the age, the quality of the tenants, the length of the leases, and the more homogeneous you can do, the higher return you can get, or a premium you can charge. So again, using that $1 million shopping center complex, a $1 million deal, and even if you increase the value, it's hard to flip it and find another buyer for 1.2, 1.3. It's very minor. But if you can assemble a portfolio of 10, and these are 10 shopping centers scattered throughout Houston or even a submarket within Houston, say like the Sugarland area, you will be able to sell that for much more than $10 million, even more than $12 million, because that stable cash flow and the spreading of risk across a large number of properties is really valuable to investors who are trying to deploy more capital. And there are more buyers that have more capital that can't do the time and energy to compile and source 10 different deals, because you may have to look at 200, 300 deals in order for you to assemble that wonderful portfolio. And there's value in that. And there's immediate unlocked value to finding those higher buyers. So let's go to the next level. Commercial real estate is the number one way to build wealth. I love this saying because as part of my informal research, and you could check out my other video, Daniel Mack on TikTok, he's the guy that runs up to supercars and says, "Hey man, nice car. What do you do for a living?" His informal poll always has real estate as some component of how they built their wealth. And sure, you get your lawyers, you get your doctors, you get software, tech people, and that's fine. But the majority of answers include some form of real estate as to how to make your money. So I'm a big believer, but according to Daniel Mack on TikTok, that's the way. Finally, you need an attorney to protect your interests. If the other side has an attorney, you can guarantee that you're probably getting screwed, or you're probably missing something that the other side's attorney has put into the contracts. So unless you can read everything and you can understand everything, reach out to an attorney to review your contracts today. Thanks for watching. Smash that like button. Subscribe if you like the content. We'll see you next time.